Hello and welcome. We have a very special guest talking to us today, Gargi Chaudhuri, Managing Director, Chief Investment and Portfolio Strategist, America's BlackRock, is talking to us. Hi, Gargi. Thank you very much for joining us today. Gargi, let's start with the biggest talking point. It seems as if the world went into elections a few weeks ago. And from what we understand, there are two sides to a Trump victory: tariff hikes, tax cuts, and a booming US economy. But that could potentially mean high inflation and a pause in the rate cycle, which was giving global equity markets the much needed impetus over the last few months. How are you viewing the Trump victory in context of US macros, rate action, and equity performance?
Sure, it's so wonderful to be here. Thank you so much for having me, and some very important questions that you've raised this morning. So, a couple of things to highlight. The underpinnings of the US economy were already really strong even before the US election. So, everything that we're seeing globally in equity markets have not just been a result of the elections, of the very decisive victory that was handed to Donald Trump, but actually around the strong labor market, around easing Fed, around a very strong growth backdrop driven by consumption. So all of that still remains. And then, of course, you bring forth some important points, which are around, what else will this new regime bring? And of course, what the market is currently focused on is this idea of financial deregulation, this idea of perhaps some fiscal easing or some relief on taxes. And the market's certainly focused on that. But I want to underline and underscore to you and your listeners that the economy that Trump is inheriting is a very strong one. The underpinnings of the macro fundamentals are very, very good. So then the question becomes, what happens to interest rates from here on? Obviously, if inflation remains as stubbornly strong as it has been in the US and doesn't reach the 2% level. And I think that's where we think that for the remainder of this year, we still expect the Fed to cut in December. And then next year will really depend on how growth as well as labor market and inflation sort of materialize from here.
Karki, you made very valid points. Trump inherits a very strong economy. Completely take your point. Strong labor market, consumption is booming. I mean, try and go out for a dinner in the US and you're going to drop at least $100, right? But that aside, if that is the case, then why cut rates? But sure, we cut rates because you were preempting a slowdown. We do agree that whatever Trump does, in some ways, more than one, is going to be inflationary. In a cycle where you have a pause on inflation, what happens to risk on or risk assets? And I think that's the big question to address because while debt is already showing early signs of inflation or rates bottoming out in some sense, my question is what happens to equities? What happens to risk on?
Yeah. So a lot of questions there, and I'll take them at a time. So the first one is around, why does the Fed need to cut? And I think this is a really important question because the rate regime that was put in place in 2022, 2023, until the rate cutting cycle started in 2024 was for a much higher inflation paradigm. Inflation was running at 6, 7, 8%. And obviously that's come back down to the very stable 2 or slightly higher than 2% level. So right now, the rate that is in effect is not the rate that suits a 2.5% inflation regime. So the Fed needs to bring rates down because it is very restrictive. And if we listen to Chair Powell recently at the couple of speeches that he has made, he's talking about interest rates still being quite restrictive. So they need to bring it down. They need to normalize rates such that those parts of the economy, such as the housing market, such as autos and credit cards, investors that are consumers that are facing those high interest rates are able to feel a little bit of relief. So that's the first point. Why are they normalizing? They're not easing, but they're bringing rates down to a more normal pace. The second point that you make is around, what happens to the risk on move that we've seen so far. And I want to highlight once again that this risk on move wasn't just a Trump-related or a Fed-related move. This is a risk-on move. The equity market at one point in the US, IVV or the S&P 500 was up close to 25%. That is something that we've seen from the beginning of this year and very much driven by very strong earnings growth. So the expectation of earnings growth for this quarter, for Q3, we're just getting in the US the earnings growth numbers, massively are outperforming expectations coming into earnings. So we're growing at about 8% this quarter. Expectation for next quarter are again at a very high single digit, if not double digit. And expectations for earnings for next quarter are in the double digits. That is what is driving equity market performance. Now, is a pullback possible? Of course, a pullback is possible, especially when we've seen such double-digit rises. But that does not mean that the market should be a seller's market. I think this is an equity market that we like. We're telling investors to look at large cap quality as well as large cap value companies, and then very importantly, take advantage of the very high interest rates that are available to you in the US markets for fixed income investors.
Such a good point, right? So you've got a strong economy, you've got earnings that are growing, you've got consumption that's in place, and you've got normalizing interest rates. Now you throw Trump in this mix. It gets even better if you're a US equity investor. And I get this, right? All of this is really good for US assets. But what happens to the rest of the world? China has problems. Japan is slowing down. The rest of Asia is not looking as great as we'd have liked. India, of course, we've seen earnings slowing down. Do you feel like the trend of money moving back to the US is going to continue for the foreseeable future? And I ask you this because with everything that you mentioned, Trump is great for the US, but bad for the rest of the world.
So I do think, and part of what I do as a part of my role is looking at fund flows as well as how our portfolio is constructed and how investors are bringing about a multi-asset portfolio. And one of the things that we have seen actually for a big part of this year has been this US exceptionalism trade. So there has been this gravitation towards US away perhaps from some of the other parts of the world, away from Europe, away from emerging markets. And I do think that especially based on the data that we have so far. And again, this can change, but from what we know so far, there is that gravitation towards US and the US exceptionalism trade where US is growing faster than many of its neighboring regions. I think that is going to continue and investors are likely going to continue to allocate in that way. Having said that, there are pockets of opportunities and it's a pleasure to speak to you. I'm from India, obviously, and it's always a pleasure to tell investors all of the incredible reasons to invest in India for a more medium-term trade in their portfolio. So I do think for investors that are looking for a country that brings that demographic growth, and you talked about consumption in India. There's a huge amount of consumption growth in the in US, but in India as well. So I think all of those stories do make the India equity market story to be quite compelling. But timing remains very important. If you're looking for the next 2, 3, 4 months, I think investors will still, or US investors at least, will still choose to allocate more towards US. And then over periods of time, they'll think about how EM and India specifically is additive to their portfolio.
Gargi, so of course, with most of your clients, there is a home bias, which is the US market. We constantly talk about why it's important to bring geographical diversification into the mix. And I think that's where India and emerging markets usually shows up. And that's the context I want to ask you this question in, right? Are you recommending to your investors buy India because you need that geographical diversification, or buy India because India is a great structural bull run?
It's both. I think when you create a portfolio, when you construct a portfolio, you want to have asset allocation based on various drivers. You want that diversification. You don't just want US equities. You want the differentiation that EM equities and other DMX equities bring to your portfolio. You want the uncorrelated nature of different markets. So there's the broader issue of having EM as a part of your portfolio because EM is bringing different attributes than a DM or a US specific portfolio. So that's number one. But the other thing that we've been talking about in terms of why investors should go into countries like Japan, as well as countries like India, is because there is a regime shift taking place. In India, it's demographics, it's infrastructure, it's digitalization. It's looking at this very young, robust demographic country, and that is going to be the driver of growth. In Japan, it's very much about reflation and profit margins picking up. So it's both. It's moving away from US because you want to construct a portfolio that has other attributes, and it's also the specific attributes that India has, as well as Japan, which is another story we like.
I'm so glad you bring that up because, back in India, everyone talks about the India versus China trade. And I don't think it's an India China. I do think it's an India Japan. Japan is the proxy to China, it is the proxy to manufacturing, it's the proxy to labor. There are so many things going on with Japan. And I think historically, when we had Trump in power, you did see Japan be a key beneficiary of additional money coming in. But that aside, if you do believe in the India story, very pointed question. After the Trump victory, did you go back to the drawing room and reassess or rebalance your allocation to various countries?
So not as yet. Obviously, this has only been a couple of weeks. I think markets tend to reprice things very quickly in the first couple of weeks after a big event, whatever the event is, and then take a step back. Let's get some of these policies. Let's understand what tariff implications are for global growth. Let's understand if there's any fiscal policy, if there's any tariffs, if there's anything done, and then let's understand what's priced and what's not. So I think that right now, we are telling investors to invest based on the fundamentals, which is around growth, which is around earnings, which is around a rate cutting cycle in the US. And as we learn more, we'll certainly tell investors that this geography versus this is shifting. As of right now, the US is looking like a big beneficiary of growth as well as earnings growth.
Let's quickly shift focus and talk about India for a minute, Gargi. Indian valuations have always been a concern for global investors. And even now, despite a 10% correction, we do still trade at a premium to our long term average. But we are a growth market, right? Earnings, unfortunately, unlike the US and India, have disappointed. The second half looks a little tentative, which also means that valuations look stretched even now. How comfortable are you with Indian market valuations, with everything you're hearing coming out of this part of the world?
Yeah, so you know what since I've started doing this role, one of the things that I've talk to investors about in the US and Mexico and Canada is this idea that India always trades a little bit rich, right? Like when you look at the rest of EM, India tends to and has done so over the last 3, 4, 5 years, has traded at what many investors call lofty valuations. There could be many reasons underpinning that. One could be because here's a market that many new investors, both domestic as well as foreign investors, are discovering perhaps for the first time, and that is a big driver of valuations. Now, as you pointed out, there has been a correction. You can argue that that correction was because of investors sort of fleeing India and moving to other parts of the world, namely China and Japan. You could argue that it's because investors are moving away from India into the US. But I think one of the broader stories is that inflation has been a little stickier in India, as we saw with food price inflation. It pushes out any expectations of rate cuts that you might have been expecting by the end of this year, maybe to the first quarter of next year. And the point that you made very earlier around earnings having disappointed a little bit, all of that has led to a reprice. As I had said earlier in our conversation, we always tell investors around the India and Japan story as more medium-term stories. This is a part of your portfolio that you absolutely should allocate to, but don't expect it to be, don't expect it to be a driver every single week, every single month. Think about these as core parts of your portfolio that you need to have if you're building a long-term portfolio. So I think as a long-term or even a medium-term story, India certainly has a lot of positive contributes, and we continue to focus on that. But can there be pullbacks in US as well as India? Absolutely. And we want to make sure that investors understand that pullbacks are a very healthy part of a market cycle.
And you need those pullbacks for incremental money to start flowing back in. But I don't know whether you're comfortable talking about this, but when you talk about India, what do you tell your clients? Buy India, buy the Nifty, sit on a passive ETF. Do you buy market cap stock? Market cap should be sort of a distinction in terms of what you buy. Are there sectors that you'd bet big on? What is the approach? And whatever the approach is, you want to tell us what you like and what you don't.
Yeah, so honestly, a lot of the times it depends on the type of client, right? It depends on the type of client, depends on their benchmark and what they're holding. We're certainly telling investors to, especially given the rally, we talked a lot about INDA, which is an India focused ETF. And then we told investors, now that we've seen such a big move, perhaps it is time to be a little bit more active in your management approach. So look at a broad EM allocation or a broad India allocation, and then pick an active manager that can, sort of not just do the sector selection, but also the individual stock selection. So I think it's not as simple as saying, yes, this is the answer every time. I think it depends on where markets are and depends on who you're speaking with. We're also obviously seeing India government bonds getting included into large indices. So we've had some conversations with clients around how to build an active EM bond portfolio as well, with a focus on India, given the changes that are taking place in the India benchmarks or EM benchmarks.
Indian equity or Indian debt for
I
incremental
think there's
allocation?
room for both. I think there's room for both in a portfolio. I would say, given some of the shifts that are taking place in terms of, being included in benchmarks in the very near term, India debt could be really interesting. And then I think over the more medium term, India equity certainly is something that all investors should have if they have a eye on where the growth of the global economy is coming from.
One quick last question, Gargi, and geopolitical. We've stopped talking about that quite a bit in the last few months. Is this a real risk? Because if this plays out in a way that none of us are going to like, this is going to impact the mother market, it's going to impact emerging markets, and everything else then sort of pauses, right? All the good things sort of take a U turn. Are you concerned? Is geopolitical a real risk one should be mindful of?
Absolutely. I think there are two or three big risks that I always am keeping in the top of my mind when I'm thinking about investors and clients allocating. I think geopolitical risk, especially over the last couple of years, given the number of wars that are taking place around the globe, I think that's top of mind, and investors building a portfolio that has a hedge. This year that hedge has been gold. In previous years, that hedge has been the US dollar, or it's been treasuries or other diversifying parts of their portfolio. So I think building a portfolio expecting or at least hedging for geopolitical risks is really very important for all types of investors. I also think there are certain other risks in the US, for example, thinking about the rising debt and rising deficits as a percentage of GDP is something that investors should think about. And I think lastly, all investors should always be thinking about, as we talked about rising interest rates and rising deficits, what impact might very high interest rates have on your equity portfolio. So those are the things that certainly I'm keeping on top of mind. Yes, geopolitical risks are very much a part of them, and building a portfolio that builds in hedges. And this year, gold has been the one that we've been telling investors to have as a part of their portfolio, has worked very well as that diversifier.
I wonder if there comes a day when we're talking about Bitcoin, just like the way we're talking about everything else. But just to sum it up, Gargi, fair for me to assume that you're not concerned with what's happening in the emerging market bag. Of course, you're not worried about the US because that seems to be on a roll, but nothing too concerning in terms of everything that you're seeing in India either right now, right? You're comfortable. This is a pullback. It's only the nature of the trade.
Yeah, I think it's a pullback. I think the broader, again, if you're looking at the medium term, I think this is a country with very strong consumption. This is a country where digitalization as well as infrastructure is going to make growth for the years ahead. And if you think about 2028, India is supposed to be the third largest economy. Why wouldn't you want a piece of that in your portfolio? Now, does that mean that we may not have another, brief pullback? No. I think we have to separate our emotions of the near term versus the fundamentals of the long term.
Right, Gargi. Thank you very much. It was a pleasure chatting with you today. We'll hopefully see you soon again.
Absolutely.
Thank you
Yeah,
very much.
thank you.
Ahead. Bye. See ya.
Bye.